Let's bust the myths of gold mining stock investing. Investing in gold mining stocks may seem complex, full of pitfalls and failures. This leads some people to equate gold mining investing to gambling. They see the volatile charts and hear confusing mining-specific jargon. This leads them to either avoid the sector entirely or make uninformed guesses. Common myths cloud their judgment. One myth is that all gold stocks move in perfect lockstep with the price of gold. Another is that all gold mining companies are essentially the same. A third dangerous myth is that miners are always a safe haven during a financial crisis. In reality, operations face pressures. These beliefs are not just inaccurate, they can lead to significant financial loss. This video will bust these myths and provide a clear, simple framework for evaluation. The goal is to replace guesswork with a repeatable process. We will build a 10-minute playbook. The journey from confusion to clarity begins now. Owning physical gold is simple. You buy a bar, you buy a coin, it sits in a vault, or a safe. Its value ties to the global price for gold. The metal does not generate income, has no employees, no debt, no earnings reports. Primary role: store of value, hedge against inflation and currency devaluation. Owning a gold mining stock is entirely different. You are buying a piece of a business that digs gold out of the ground. It has revenues from selling gold, but also massive costs: labor, fuel, equipment, exploration, and admin. Management decisions, assets, cash, liabilities like debt. This is an operating entity. The business aspect introduces leverage. At $1,500 cost, margins jump from $500 to $1,000 as gold moves from $2,000 to $2,500. Operational leverage can multiply gains and losses. You are betting on gold price and company execution. Understanding this difference is the first crucial step. Section 3. Debunking common misconceptions. Myth: miners perfectly track the gold price. Reality: company-specific factors matter. A new discovery can send a stock soaring even if gold is flat. Operational shocks, floods, labor strikes can sink a stock while gold rises. Cost spikes crush margins regardless of gold. The industry splits into producers, developers, and explorers, each with distinct risks. Producers: larger, more stable cash generators. Developers: construction and financing risk with big upside. Explorers: most speculative, most programs fail. In crises, credit can freeze, and miners, especially indebted small caps, can spiral. Forced selling hits all equities. Even quality producers can drop sharply. Treating miners as one group is a recipe for failure. Differentiate by stage, financial health, and operational quality. This is where a disciplined playbook becomes indispensable. To evaluate a gold miner, you do not need hundreds of data points. A handful of metrics tells most of the story. First, annual gold production in ounces. It signals scale, from million-ounce majors to sub-100K juniors. More important is the trend: growing, stable, or declining. Healthy operations replace the ounces they mine. The single most important metric: all-in sustaining cost, AISC. It includes mining and processing, overhead, and sustaining capital. Low AISC, margin of safety. At $2,300 gold and $1,300 AISC, margin is about $1,000 per ounce. High-cost miners are vulnerable to gold price drops. Next, look for positive operating cash flow from core operations. Free cash flow, the lifeblood, is is cash remaining after capex. Quality companies use FCF to reduce debt, fund growth, acquire assets, and return cash to owners. Chronic cash burn is unsustainable. Finally, examine reserves and resources. Focus on proven and probable. Reserve, life, P&P. Reserves, annual production. Numbers matter, but qualitative factors drive long-term outcomes. Great managers allocate capital wisely and deliver projects on time and on budget. They avoid excessive debt and stay transparent with shareholders. Research the leadership track record. Watch for histories of delays, overruns, and value-destructive deals. Jurisdiction risk is real. Taxes, royalties, even nationalization. Stable jurisdictions reduce uncertainty, though no place is risk-free. Mining is complex. Things go wrong. Wall failures, floods, breakdowns, labor disputes, risks that halt production. Ore grade variability and metallurgy can make or break economics. Diversified portfolios cushion single-site issues. Exploration upside is optionality, a bonus if it hits, but it is expensive and low probability. Base your thesis on profitable existing operations, especially for producers. Big land positions in prospective belts add long-dated upside. Balance management quality, jurisdiction, operational risks, geology, and diversification for a complete picture. Once quality is assessed, decide if the stock is cheap or expensive. Use market cap per ounce of proven and probable reserves. If peers with similar costs and jurisdictions are at $400 Oz, $200 Oz may be undervalued. Lower is not always better. Adjust for cost, country, and reserve life. Check price to NAV. Banks often publish NAV for majors. Run a gold price stress test to see margin of safety. Go to investor relations. In minutes, pull the quarterly MD&A. Grab production, AISC, and realize price to compute cash margin per ounce. Healthy cash and manageable debt signal resilience. Check if guidance is on track. Cuts are a warning. Note P&P reserves for reserve life and valuation. Compare market cap per ounce across peers. And Duckworth. Apples to apples. Scan recent ops updates, leadership changes, and policy shifts. Allocate 2%, 10% to gold equities and diversify across 3 Tar 5 names. Anchor with quality producers, add growth, keep the specs small, define targets, stops, and review quarterly.